Hello, this is Ken Tomko from T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They are for information only and review of what we're looking at. Always start here with a weekly chart of the S&P 500, and you can see here the bear market from 22. This goes back to 2019 here on the left side. There's the COVID sell-off and big rally following. Then the bear market as interest rates were rising to try to tamp down inflation. And now it looks like we've started on to a new bull market as we've recently hit all-time highs in the S&P 500. As you can see here, it's just been quite a rally to finish out the year of 23 and to start 24. Again, one that many pundits said, oh, we're going to have a big sell-off for last year, and that did not happen at all. You see we're starting into, as I said, a new bull market. See how it all resolves, but as of right now, certainly the long-term trend, the weekly chart here is up. If we go down here and look at the daily chart, a little more detail, and you can see the choppy nature of 22 in the bear market, and we spent about a year or so there just going sideways. Now it's been all up really since the beginning of 23. We had a little bit of a pullback during that summer, and it's extending on now into 24 as interest rates seem to stabilize, and the Fed is talking of perhaps lowering interest rates at some point. We still have a bit of inflation, so they're not doing that just yet. But anyway, the stability in the markets have caused a rally, and here we are. We're seem to be heading up in both the weekly charts and the daily charts. Come down here to 2-hour chart. This gives us a look at the last 6 months trading on the S&P 500. And you see the channel that I've highlighted here as it's going higher. Come back and sort of test these levels again and again, but still moving higher. Certainly, one of the things that we're concerned about here is as I look at the breadth of the market, and that's the number of stocks underneath that are really participating in the rally. This is the percentage of the S&P 500 that's in an uptrend. And during December, there it was up to 81. Right now, we're back to 66%. And the next chart down, this is the advanced decline line on the New York Stock Exchange. Also gives us a measure of how many, whether it's just a few stocks leading the way or the whole market. And that's actually weakening too as we're coming up here to new highs. So this lack of breadth in the market is definitely concerning. The final line down here is the VIX, the volatility index, and this measures what people are paying up for insurance in the options market for protective insurance against their portfolios. It's not really rallying right now, so that's not a great concern, but the decline in breadth is usually a sign that a market may be taking a pause soon, but it hasn't shown up yet. For those who had really big gains up here, this might be a place to adjust and move to a little more safety as some of that breath is rolling off there. But you can also just keep going and wait for it to break a trend as well. Part of the reason for the rally going on here, this is the interest rate on the 10-year US bond. And you can see it was very, very low here in 20. This goes back to 2014 on the left side. And then rates have been rising and rising and rising here for a period of years to try to tamp down on the inflation from all the money printing. We had gone up to 5% on that 10-year, and now it has backed off in recent months. And that's largely the reason for the rally that we're seeing right now. A stabilization or maybe even a decline in interest rates would have good effect on the stock market. If we look at the economic situation underneath, go here to trading economics, the GDP growth rate. It's certainly slowing a little bit. You can see the previous was 4.9, it's 3.3, but still a positive number. We come down here to non-farm payrolls, the jobs number. Again, these are steady numbers. We're growing fine there. Not really a big problem. Inflation staying in the 3% range, but certainly better than the 9 or 10 or what have you that it was a year ago. Go to retail sales. That's actually picking up a little bit too. Again, shows a positive trend. So not really seeing too much in the economic numbers that are showing we are going to have a problem anytime soon. If we go here to the forward earnings estimate for the S&P 500, again, analysts are thinking that the earnings in the S&P 500 are going to be just fine and continue higher. So again, it shows a positive reinforcement for the market going forward. The biggest issue that you run into here is the valuation on the market here, and this will show this 3685 is what the 20 times earnings would be for the S&P 500, which this chart labels that as overvalued. But the new normal seems to be that if you could stay somewhere around that, that would be fine. Well, we're getting quite a bit far away from it right now, so certainly we just have some stretched valuations and reason to be a little concerned that some of this recent activity, the giant rally in the last 3-4 months, may have to take a pause or adjust. But again, these are never good for timing. They're just to let you know where you are in the cycle. That hey, listen, it's probably a little bit overvalued here, and to watch out. So currently, we do have all the long-term money invested, maybe a little bit light on the stock market as we came up to these highs. It's just been a little bit too much too fast, but I would have no issue with sort of staying invested here and letting the market tell you just yet. And certainly the interest rate scenario with it backing off a bit is positive, but I would say if we start to see interest rates move higher again here, that's probably going to be an issue for the stock market. So I hope this was helpful and informative. Keep everybody abreast of what's going on. I'm going to put up our contact information here if you'd like to hear anything more about what we're doing in our portfolios or how we're handling these complicated markets. Please reach out at any time. Appreciate it, and we'll see you at the next update. Thanks so much.